In this session, I'm going to talk about the different newer markets that are available for credit transfer and what are their implications. Wherein, so we will be looking at the securitization process and how the subprime mortgages have been typically securitized and how they really contributed to the global financial crisis 2007-9. What were the key flaws with respect to the securitization and the subprime mortgages that came up before the financial crisis? So, what are the typical issues that required to be addressed? What are the different kinds of mechanisms that are available to mitigate the credit risk? Right? So, out of that, how should the bank credit function? What are the kind of improvements? What are the lessons learned for the bank credit function from the financial crisis? What kind of modifications are expected in the bank credit functions? Right? How should a bank change its credit providing facilities? Then, what do we mean by credit portfolio management? How do we create a credit portfolio? What constitutes a credit portfolio and how is it typically managed? Then, transferring to the third parties using various credit derivatives. So we would be looking at different kinds of credit derivatives like credit default swaps, understanding how they really help in transferring the credit risk. We'll look at a few other alternatives, which is like a first to default put. We'll look at total return swap. These are different kinds of financial instruments that are available for transferring the credit from the risk mitigating party to the risk taking party. Similarly, we have other options like asset backed credit linked notes. We have spread options. So all these are the different kinds of credit derivatives available. So we'll look at how they really function, how they really mitigate the credit risk. The overall securitization process of the credit risk, how it takes place, is something that we are going to look at. And finally, another important tool for transferring the credit risk or mitigating the credit risk being the collateralized debt obligations. So again, there are different forms of CDOs. There are cash CDOs, there are synthetic CDOs. So we see what is the kind of differences that are existing in each of these instruments. So on a whole, it's about the different ways in which I can transfer the credit risk from one party to the other and how they are really going to influence or create an impact on the other markets. Now, some things we are very comfortable with by now. Securitization as a definition. You all know it's a mode of collation of the loan, collecting the loans, right? Whatever are issued by the banks, you collate all the loans, you repackage them into different assets. You repackage them as different financial instruments that can be sold to the investors. You repackage them as bonds or different bonds with different credit ratings, and you resell them to the investors. So it could be any kind of a loan. I can talk about a mortgage loan, or I can talk about student loan, vehicle loans, whatever are the loans, different kinds, or even other assets like accounts receivables, credit card receivables. There could be different kinds of assets. They are repackaged and they are sold to the investors. And which means the loans which are primarily illiquid, they are made more and more liquid, right? And all other risk, interest rate related risk, credit risk, they are removed from the original loan, because that loan, the risk associated with the default of the borrower is not just the risk of the bank. Now it is shared by various investors in that particular product. Earlier, if there is a default by any one of the borrowers, the bank would be at risk. But now the bank has repackaged those assets and sold them to different investors through the securitization process. So this default is borne by the various investor community. So the credit risk from the bank is reduced, the interest rate risk is reduced, all these, even a prepayment that could typically happen. Earlier, the bank used to get exposed to the prepayment risk, but now again, it's the investors who get exposed to the prepayment risk. So, it has really played a major role in reducing different kinds of risk to the bank. So, we all are very comfortable with that. And this was typically called as the originate to distribute. We are initiating the loans. The bank is typically originating the loans just to distribute them to the investors. That finally came out. That was the kind of a process that came out. The credit risk, which was typically faced by the bank, was passed on, was sold to the investors. Now, investors are the bearers of the credit risk. And that has happened through the various mortgage-backed securities, asset-backed securities, and any other products. Right? So basically, that was what is the intention. We know that, okay, there are so many borrowers for a bank. So there are so many loans that the bank has issued. So these all loans become the assets of the bank. Now these assets are converted and they are sold to the investors. Investor 1, investor 2, investor 3, which means this is like an investment to the investor. The investor is supplying the funds at the moment, and this part of the asset is being sold to the investor. And the cash flows are like when the principal and the interest are received from this party to the bank, they are typically passed on to the investor. So the credit risk which the bank was facing in the earlier case, now it is getting transferred to the investor. And this entire process, the major driver for this is the capital adequacy requirement of the Basel, wherein you have to use your capital very much optimizedly. And even you could see here, upfront revenues are getting generated because the bank is selling these to a third party. Even the accounting and the regulatory standards have not put any such kind of restrictions on this model. So the bank is able to generate an upfront fee revenues because of this process. And the originators, whosoever has originated this particular loans, they had a good capital efficiency because they got back the capital initially. So their capital requirements are becoming quite steady. So they got a very good capital efficiency, which means because of that they were able to raise more and more funds. And because they already have received the money from the investors, the volatility of their earnings also has reduced, which means their credit ratings have improved, their consistency has improved, and the capital efficiency also has improved quite drastically for the originators, which are the banks. And even from the investors' perspective, if I look at now, earlier they never got an exposure to the loans. Right? They have invested in some instruments, stocks, bonds, mutual funds, but they never have invested in a loan kind of mechanism. But now, with these kind of instruments, they got exposure to different kinds of loans. So they have more investment choices now. So they are able to diversify their risk more and more effectively in line with the kind of risk they are willing to take, in line with their risk appetite. Now look at from the borrower's perspective. Now originator is the bank. Bank got a benefit because of this process. Investors are benefited by this process. Now, what about the borrowers? Now, they got wide varieties of options now. The credit availability got increased. Different kinds of credit opportunities are there for them. So their overall costs have typically gone down. Their borrowing costs have typically come down in the process. Now, securitization has really helped the borrowing and lending industry, has taken this kind of an industry into a completely new dimension altogether. So it's become a key funding source for the consumer as well as for corporate lending. But what were the typical flaws? Even though it looked like it has created a lot of advantages for different parties who were involved in the process, what were the key flaws of the model? First thing, if you observe, the incentives, right? The bank, in a regular manner, if you look at in a normal loan process, if the bank is giving a loan to a customer, it does the due diligence of the customer quite heavily. It assesses the credit worthiness of the customer very heavily. But now there is no incentive for the bank or for any lender to monitor the credit worthiness of the borrower, because the lender is very clearly of the opinion, anyhow we are going to distribute the losses, anyhow we are going to sell this loans to a third party and finally to the investors. So the credit risk is getting transferred. Why do we really pay an additional effort in terms of monitoring the credit worthiness of the borrower? So, which means even the not so worthy borrowers came into the bank, got loans from the bank. So that is what we are calling as the subprime loans. So now the loans have become more and more subprime in nature, or even if they have assessed the credit worthiness, they did not reject the loans, because anyhow they are not bearing the risk, they are going to transfer the risk. Now look at the intermediaries. They did not retain any of the risk. They passed everything to the investor. The income and the bonus for for creating this kind of instruments, right? The intermediaries, the financial intermediaries who were mediating this process between the bank and the investors, for them their income and the bonus was completely tied up with the completion of the deal, but not to the quality of the deal. Another major flaw in the process. And the credit risk was transferred to as SPV, which is a third party vehicles, and that SPV structure was very complex and it was not transparent. It's only the rating agencies that were giving a rating to that particular third party entity, and majority of the time the rating agencies have given a AAA kind of a credit rating. So the heavy reliance was there on rating agencies and the different kinds of credit enhancements that were provided to safeguard against any kind of additional default. So the SPV structure was very complex. The originators typically did not understand the complexities of the SPV structure. They only felt that this is a very highly credit, this is carrying a very high credit rating, so least prone to default. And all the securities that were offered, there was a lack of transparency in the entire process. The regulations were very limited on the top of them, so the transparency was very lesser there. And at the same time, okay, even if the investor is exposed to risk, he can protect himself against that risk by going with the credit default swap. Credit default swap is an instrument which is protecting an investor from the default of a reference entity. So the CDS market has grown parallelly. So which means the credit instruments became more and more liquid. At least they are perceived to be more and more liquid. Any kind of default occurs also, there is enough protection for the against the default of a particular party. So that's one more advantage that came out. But again, it was only the perceived liquidity that has gone up, but in reality that did not happen. And the financial crisis of the 2007, it has primarily occurred because the banks did not follow the order to distribute model incomplete. Though it was an order to distribute model, on the periphery of it, we can see that they have originated to distribute kind of a model. They have originated the loans to distribute them. But if you look at it slightly in deeper, they did not implement the model in full. The reason being, whosoever are the investors who have invested in the loans that are being sold, right? I said this is the bank. Bank has sold all the loans to a third party. The third party has instead, this third party is an SPV. This SPV has created the various instruments out of this, and they have sold them to the investors. The biggest flaw in the process is this majority of the investors again are the same banks. So it's just a flow. So the majority of the investors, they took the role of, majority of the banks, they took the role of investors. So instead of the risk being completely diversified, again those are the parties who got exposed to the risk. Right? So the risk was concentrated primarily in the entities that was typically set up to reduce the risk itself. Now this is the kind of, they did not really seriously follow the originate to distribute kind of a model. And that is where the whole crisis typically cropped up. And what we could clearly see is the cost. If I am holding a AAA rated CDO tranche versus having a loan. AAA rated CDO tranche used to be a part of the trading book of a bank, whereas the original loan is a part of the banking book. Now, as per Basel, the capital requirement for against the credit risk in the banking book is much higher compared to the trading book. And so all these loans, they were gone through the securitization process, and finally the investment is still done by the same bank, which means they have actually converted their banking book into a trading book, but the risk is not fully transferred because it's again they are taking the same risk again. The only thing is, from a regulatory perspective, something has changed from a banking book to a trading book. And because of that, their capital requirement has gone down. That was the only thing the banks have typically looked at in the entire process. So banks have set up their investment vehicles to warehouse the undistributed CDO tranches, whatever the CDO tranches that did not get distributed. The banks had different SPVs floated just to warehouse those undistributed CDOs. And that is one of the major flaws that has contributed to the entire process. So which means there are key important points for us to look at. It's not a securitization as a concept that has failed. It is the originate to distribute model which has not been fully implemented has really contributed to the crisis. Now look at the special investment vehicles or special purpose vehicles that are created. They are leveraged. Obviously, their loans are raised against those SPVs. So, for them, they had a serious liquidity mismatch. They had serious maturity mismatch. And because of that, there is a high chance of a classic bank run that can happen. A sudden pullout. Now, liquidity is a serious issue for those kind of entities because they have a high debt to equity ratio. So, liquidity is a serious problem, and in case there is a run on the bank, probably the whole thing can be collapsed quite dangerously, and that is what has happened to a good number of banks. Look at the rating agencies. They did not have solid models to understand how the liquidity and the credit concentration risk exists in case of these kind of instruments. And they really did not have any kind of models or mechanisms which suggest how these risks typically crop up when the economy is not doing well, when the economy is in a downturn. So there was some problem from the rating agency's perspective. Look at investors. Investors did not have a solid way to evaluate these investments in detail. For them, everything was complex and opaque. Right? The transparency was a bigger problem for them. They could not understand the composition of the assets that are there in each of these vehicles. They have relied heavily on the rating agencies, and that's it. So, which means once the market really started crumbling, these guys, the investors, did not have any kind of a way to evaluate the process. Suddenly their confidence has gone down. As long as things are going well, investors who believed the rating agencies and the system as it is, they were really making money. But once the system market started falling down, they could not have any way to analyze why things were going down. They became very panicked. Their concentration gone down, resulted in heavy number of sell-offs, which has resulted in further worsening the values. Now, from the bank's perspective, understanding the risks, they misjudged the risk. Right, to the various vehicles that were being created, they were not able to understand the risks of the borrowers and understand the risks that are associated with investing in these kind of vehicles. And financial institutions, they really adopted a model where they could have got continuous access to funding liquidity, especially companies like Lehman Brothers. They got into such kind of a business model where they really felt that raising funds would never be a concern. They get continuous access to the liquidity, market liquidity, funding liquidity, as well as the asset market. Whenever they want to sell off something, whatever is the volume, they should be able to sell off. Whenever they want to raise funds, they should be able to raise funds without any kind of a difficulty. That is the kind of model which the financial institutions have typically assumed. But what we know, we know that the reality was something much difficult. Even the commercial paper had a difficulty, and even the repos had very much difficulty. The liquidity of these kind of so-called liquid instruments have really worsened during the crisis period. And the firms that really made a big business when they were actively packaging the various loans and selling the exposures, they had large pipelines of unsold kind of instruments. So they have taken a big repository of all these unsold kind of instruments, which means their exposures were drastically higher. So the bank leverage, the kind of leverages they have maintained, even 40 plus used to be the typical debt to equity ratio. So the bank leverage was quite drastically high. Origination practices were not that effective, and towards the end it so happened that they faced a liquidity crisis. Right? They were not able to raise funds. All these things have really contributed to the crisis in a very, very bad manner, which means these will become the lessons for us for the next, so that the next crisis is way away from us. So some of the important things that we really look at is the incentive. Incentives, especially for the financial institutions which have intermediated the whole transactions, we see that the incentives are majorly with respect to the closeout of the deal, but no one was bothered heavily about the quality of the deal. So the entire securitization chain, whatever are the incentives that are there in terms of transferring the risk from one party to the other, it needs to be really thoroughly evaluated. Right? It should not be in a search for short-term profits. The entire genuinity of the model needs to be evaluated. That's one thing which we have seen as a serious problem during the crisis. Then comes the issue of transparency. Different kinds of securitized products. What are the characteristics of these products? What do they resemble? What other products do they resemble in closeness? Right? How do the credit rating agencies typically have given a kind of AAA rating to these kind of instruments? So there should be a deep assessment of a quality which was missing during that period. And probably the one that is a very serious concern is a potential correlation that is present between the different assets. The default correlation that could be existing between the different assets need to be evaluated in depth. And we know there is a possibility of a wrong way risk very heavily today. So a good understanding of a wrong way risk also need to be evaluated. And the poor management of the risks associated with the securitization business. Whatever the risk that got originated, how do we really mitigate them? Stress testing was not done effectively. So that's one more area for us to improve in the future. And credit rating agencies were very heavily relied upon. So the entire thing, transparency of the credit rating, accuracy of the credit rating agencies was typically believed in full, and which is what has which because of which people they did not do any kind of independent assessment of the credit worthiness of each of the parties along the way, which has also contributed very heavily to the crisis. So these issues that cropped up during the period of the crisis, those are the ones that need to be addressed in the future. Now, moving on, what are the different kinds of techniques that are typically available to mitigate the credit risk? Okay, one is a bond insurance. So basically it's like the lender is taking an insurance to protect the purchaser of the bond. So it's basically like any other insurance, like a car insurance that I take to protect myself against the losses that can come because of various reasons to my car. Health insurance, it's a kind of protection that I'm going to take against the losses that I can incur because of a deterioration of the health. Similarly, I'm talking about a bond insurance where the issuer can, the investor, okay, here it's the lender who is purchasing. In some cases, the issuer who is the borrower also can purchase it and give it to the lender. So, either of the parties can typically purchase it, but yes, the benefit is to the lender. In case the borrower is not able to pay the interest and principal as per the required terms and conditions, then the insurance would come into picture. So because the insurance is there, if the issuer has purchased the insurance and given it to the lender, so that is like a credit enhancement, right? The issuer is providing a credit enhancement, so the cost of borrowing is typically going to go down in the process. There could be another way in which the credit risk can be mitigated through different kinds of guarantees. Letter of credit is one such mechanism. So the guarantee is provided by a third party which is typically having a very high credit quality. So that party guarantees that if a party X defaults, we would be paying you the amount of the default. So there is a kind of a guarantee or a surety that is provided by a third party. Then the other mechanism to mitigate the credit risk is have a collateral. So in case there is a default, and because of that the borrower is not able to pay, this collateral can be liquidated by the lender, and the lender can take the proceeds out of the liquidating of the collateral. But one thing that we need to understand here is the value of that collateral also can fall down. Probably it's like this: I have kept my house as a collateral. Now I have defaulted. So the bank can typically sell off my house and get the proceeds. But it might so happen that it has to sell off much faster. I have to sell off my house much faster to typically pay to the bank. And it might so happen if I have to be selling it so quickly, I may not get the price that I typically expect, because liquidity is a concern. I may be forced to sell the product at a much lesser price, and that's what could lead to a big loss. So even the value of the collateral can be very much volatile, and it may so happen that there could be a wrong way risk also. Probably when I am defaulting, it might, as long as I am paying my loan well, probably the property that I have kept as a collateral is also doing well. But let's say during an economic downturn, when I started defaulting on my loan, and that is the time when the bank can use my collateral to get my loan repaid, but it has suddenly found that the value of the collateral also has gone down when the economy has gone down, which means there is no use of that particular collateral, right? When it is really needed to be used, it's not giving any kind of a benefit. If that's the case, what is the point in having that as a collateral? So that is what we are calling as a wrong way risk. So when there is a typical kind of a collateral which is expected to mitigate the risk during the time of a default, but that collateral also loses its value very badly along with the original, which means the collateral is no more providing any kind of a benefit. That kind of a risk that is associated when there is a high amount of correlation that is existing between the exposure and the collateral that is being used to mitigate that exposure is what we call as a wrong way risk. So that's one thing we have to be cautious about, the collateral. Then the other way to mitigate the credit risk is early termination, which is agreed mutually by lenders and borrowers. They can agree upon a mid-market quote of occurrence of on the occurrence of any event, and they can simply settle off the entire process. That's a simple and easier way to get out. Or there could be a mechanism to reassign one's position as a counterparty. So A and B have got into a kind of a transaction. B's position can be, all the B's trades can be reassigned to C. So now it would be between A and C. So this is a kind of a reassignment mechanism. Or there could be a netting mechanism in place where there could be a netting of the different kinds of values on different transactions that are existing within with the counterparty. So with one transaction, if the value to counterparty A is 5 million, on the other it is minus 2 million, and on the other it is minus 1 million, the total exposure can be made it as plus 2 million. This is what we are calling as a netting. So the value represents the true credit risk exposure. It's not treated separately for each one of them. We have seen in this in depth in the netting chapter. So where without netting the exposure is 500, only positives will be counted, which is 5, but with netting the exposure is only 2. So this is one way to mitigate the credit risk. Then we are talking about a marking to market kind of a mechanism. wherein at a regular intervals of time, probably on a daily basis or even intraday basis, any change in the value of the portfolio, the amount is transferred from the losing party's account to the winning party's account. So even though a credit risk is going to exist, that amount will be very, very small, because by now whatever has to be transferred has been transferred from the losing party to the gaining party. So the only thing is, in this case, the IT should be very, very effective. The monitoring mechanisms need to be very effective. The back office processes, which are the IT and the support systems, should be very, very effective in tracking all these entire processes. And finally, there is one more mechanism that can be looked at, which is an embedded put option. So it's like again a default protection. So whenever because the put is having a kind of a right to sell, so the investor here, he has the right to sell at a specified price whenever he really wants to. So when he is seeing that the economy is in a very downward situation, or probably when he sees the company is going more and more into a default, that particular put option can be exercised and the redemption can happen at a pre-specified price. So you could see that there are different ways which are engaged internally. You see, majority of these mechanisms are internal mechanisms which the bank or a lender can typically adopt to reduce the to reduce the credit risk in the lending transactions. And there could be few more ways, right? One, while you are writing the loan itself, get into a syndication process, right? So especially when a large loan is being taken, when a borrower is taking a large loan, instead of bearing that whole burden with one single bank, share that risk with the various lenders. So some portion of the loan is sold to other institutional investors, rather than one single lender taking the responsibility of the entire loan, large loan, to one single counterparty. Here the portion of the loan is lent to various institutional investors like the bank. So there will be one lead bank which is providing the loan to the borrower, which has the largest share, but some portions of that share are sold to different institutional investors, which are the other banks which are sharing the risk of the default of the borrower. So there could be a firm commitment deal where the borrower is guaranteed the full face value of the deal, or it could be a best efforts deal, to whatever extent different parties are willing to share the risk. So that's the best effort of the loan that would be typically provided to the borrower. But they have a lack of flexibility because they cannot unbundle the credit risk from the underlying position. Credit risk is not removed there. Its only thing is, in all these products, the credit risk is only redistributed to the investors. The whole securitization process or loan syndication process, they really don't eliminate the credit risk. They are only redistributing the credit risk to all other investors in the process. And we have very powerful instruments of the newer age, which are called as credit derivatives, which are typically the off-balance sheet arrangements wherein one party is transferring the credit risk of any single asset to another. So basically it's like, this party is the risk mitigating party. They don't want to keep the risk, and so risk averse kind of a party or risk mitigating kind of a party is transferring the credit risk to another party, which is a risk taker party, but there is no selling of the asset. In securitization, the bank has sold the assets to the SPV here. But in case of credit derivatives, The assets are typically not being sold. The only thing is the risk is passed from one party to the other through various instruments. And the other advantage is now in many instruments we would be seeing that credit risk may not exist after doing this process. And the credit risk is completely stripped away from the market risk, which is primarily because of interest rate movements or exchange rate movements or stock prices movement or even the commodity prices. Any of these prices fluctuate. So the credit risk is completely stripped away from the market risk, and the trade risk is completely transferred independent of the funding process. So funding liquidity risk does not come into process here. And we have to also understand that the various counterparties should understand the real amount of risk that is transferred, the nature of the risk that is transferred through a derivatives contract. Now here, the financial institutions typically can segment different kinds of potential risks and from a pool of portfolio credit risk exposure and sell these risks separately to each of the investors, to different investors. So in this process, we see that the price discovery happens to the credit and economic value, the market typically attaches to a kind of credit risk. For each of the credit risks, what is the value the market is typically giving it? So that is something that comes because of this credit derivative instrument. I want to transfer a particular X company's loan credit risk to the investors. Now, what should be the price the market is willing to pay for it? What is the economic value the market is looking for this kind of a risk? All these things come out. That is what we are calling as a price discovery. So the overall we could see there is a liquidity improvement, pricing is becoming more and more efficient, credit spreads are becoming more and more rational, and that's where the credit derivatives have really contributed as wonderful instruments for mitigating or transferring the credit risk from one party to the other. Now let's look at what are the different ways the banks can really look at to reduce their credit risk. First, let's observe, can the bank change its credit function? Right? This is where we talk about a change from a traditional approach to a portfolio based approach. If you look at the investment strategy earlier, the bank used to typically buy the loans, which is like issue loans and hold them till the expiry of the loan. But in the portfolio based approach, we are simply calling originate to distribute. Whatever the loans you have got, sell them to a third party and let the third party issue financial instruments to the investors. So originate to distribute is a portfolio based approach, whereas in a traditional credit function, yes, you give a loan and you keep receiving the interest and principal at regular intervals of time, and you hold on to that loan until the complete payoff happens. Then when I look at the ownership of the credit assets, which are the loans, the bank is the owner of all these loans. But now here I have distributed them to a SPV, third party. So whatever is the portfolio management unit of that particular firm or a third party or a business unit of the same bank is typically looking at the portfolio management unit of the bank or a third party is taking care of the ownership of the assets here. Look at the risk measurement here. The notional value of the loan has to be used because this loan has not been distributed. The entire notional value of the loan has to be used as the entire value of the loan is used for measuring the risk. And here the losses are typically arising only because of the default, the customer defaulting on the loan. Whereas here, because the risk is already transferred, risk-based capital is used to measure the risk. So here there are two. The default also could contribute to the risk, and even the risk migration. Probably the downgrading of the risk, the migrating of the risk from one party to the other also contributes to the overall risk here. Management is just a simple binary approval process, whereas we are using the risk return decision making process. And compensation for the loan origination is purely based on volume here, whereas it's risk adjusted performance in case of a portfolio based approach. And it's a grid pricing, whereas here in a portfolio based approach we see a risk contribution based pricing. Valuation in a portfolio approach is done on a mark to market value, regular updates, and whatever the transfers have to happen from one losing party to the gaining party, all those are happening on regular basis, whereas in case of a traditional credit function, the valuation is held at book value itself. So this is how we could see, if at all the banks really change the way they look at the credit function from a traditional approach to a portfolio based approach, these are the different kinds of improvements that they have to bring into the process. So overall, if I look at the credit portfolio management process, this is how. So we have a credit portfolio management group. Credit portfolio group typically looks at the credit portfolio management, they look at the counterparty exposure management, and they also provide the credit portfolio solution. And this, if you look at the turnaround of the capital, right? You have issued the loan, and you have sold the loan to the third party. So your capital is becoming more and more fast turnover. Turnaround of the capital is much faster, which means your volume of the business is going up quite heavily. Concentration risk is going down. One party defaulting, you are not the only responsible, you are not the only party who is affected because of this default. Now it is shared. The return on the economic capital is very much improved because now there is a little volatility in your earnings, because you have already known how much you have got out of the selling of these entire package of loans. So because the risk is lesser, return on the economic capital is going to be much higher. And they are responsible for the financials, but they are not a profit center. That is how the credit portfolio group comes into picture. And looking at the kind of tasks, they are hedging and trading the retained credit portfolio. Whatever is the retained part, they are not keeping it static. It's a dynamic work on it. There is a trading that is happening on it. There is a hedging that is happening on that portfolio. So we have research analysts, they have a research analyst, portfolio managers, traders who get actively in the process. Counterparty risk of the derivatives exposure is typically monitored and managed on regular basis. And they also provide an advisory function to the various originators on the banks on how this entire structuring has to be done and how it really contributes to the mitigation of the overall credit risk. So the different kinds of mechanisms, if you see the large loans through syndication, they are distributed to the other banks. So that syndication is done at the beginning of the deal itself, at the beginning of the initiation of the loan process itself, that kind of a syndication is gotten. And after that, whatever is the loan exposure that is there, a portion of it can be sold down or it can be hedged. And so the major focus typically is on high risk obligors, the borrowers who have very poor credit ratings, who can pose heavy risk, where they are very heavily leveraged, where they have high volatility of the returns. The focus is primarily on those kind of obligors or the borrowers. Along with that, there is a selling or even the hedging of the low risk, low return loan assets to free up the capital. So the low risk ones are fully hedged, the high risk ones are typically concentrated, and that is the way they try to create an advantage by reducing the risk in the overall process. So there is a combination of a traditional approach as well as a modern mechanism to optimize the risk return profile of the portfolio. And the whole documentation process is typically playing an important role in the way the loans are typically transferred. Now, let's move a step forward in terms of looking at different kinds of credit derivatives and their application. So look at the advantages because of the different kinds of credit derivatives. As I have already indicated earlier, the investors, they are getting access to the previously unavailable kind of markets. They never got exposure to investing in the loan market, right? So here, and that to different kinds of loans, whereas here they got the flexibility and they got the opportunity to invest in different kinds of loans. They are able to clearly segregate the market risk from the credit risk. So the entire unbundling is a very smooth process here. And investors are able to borrow the bank's balance sheet. Right? Earlier it was not possible. Whatever was there on the assets of the bank, the investors are able to borrow the balance sheet of the bank. And the investor does not have to fund the whole position, but at the same time he does not need to do a due diligence. The investor need not look at the cost of servicing the loan. All those are taken care of the bank, but that portion is typically being taken care by the investors. So they got an exposure to different kinds of risk altogether, different kinds of investment. Yield enhancement is typically happening, and the sovereign risk of the asset portfolios is typically getting reduced, because there is a possibility that all these investments can happen in multiple geographies as well. From the bank's perspective, yes, their credit concentration is going down because they are able to redistribute their credit risk to the various investors. So their credit concentration is typically going down, and they are in a position to manage the risk profile of the entire loan portfolio rather than looking at one single loan per se. From a company's perspective, they are able to hedge the trade receivables and any kind of overexposure. This is one advantage in a counterparty risk mitigation strategy. Overexposure to one single customer or one single supplier can be reduced by getting into a credit derivative, and the entire sovereign credit related can very well be got in because the risk is typically shared in the process. Now we have different kinds of instruments which are being called as credit derivatives. In our earlier few sessions also we have looked at the different kinds of credit derivatives like credit default swaps, right? So let's quickly run through what each of these instruments have. So credit default swap, it's a kind of an insurance, but it's not the similar as bond insurance, right? So here it's a default, it's against the default of some underlying instrument. So it's like a put option on the underlying instrument. So there is a protection buyer who is selling the credit risk that the party is having to a protection seller who is ready to assume credit risk, right? And just like a premium, there is a periodic payment that is being made by the protection buyer to the protection seller, and the amount that is typically paid is some number of basis points which are being agreed upon by both the parties, and that basis points times the notional amount. So the amount that is typically being paid as a premium at regular intervals of time, by the protection buyer to the protection seller is in terms of basis point, which is negotiated between the parties, based on that multiplied by the notional amount of the underlying loan. Now, the party who is buying the credit risk, which is a protection seller, that party keeps receiving the premiums at regular intervals. It does not make any kind of a payment unless that reference entity for which the protection buyer has taken a protection, that particular reference entity, it could be a bond or a loan, if that defaults, the protection seller is compensating the protection buyer equivalent to a default payment, which is the notional amount minus the pre-specified recovery factor, assuming there is some portion of the amount that is recovered. So if the loss is let's say 1 million, 20% is assumed to be the recovery rate, then the amount that the protection seller is going to pay to the protection buyer is $800,000. So look at the pictorial representation of it. We have a protection seller, we have a protection buyer. Regular intervals of time, the protection buyer is making some premium payment to the protection seller. So X basis points per year is typically being paid, multiplied by a notional amount of the value of the loan or a bond. So regular intervals, the protection buyer is paying this much of amount as a premium to the protection seller. And in case a credit event has occurred, the default payment is typically being made by the protection seller to the protection buyer. The default payment is whatever is the notional amount of the loan minus, if at all there is some amount of the recovery factor, recovery amount that could be there. After the recovery, whatever is the loan whatever is the loss that is still outstanding, that would be typically paid by the protection seller to the protection buyer. And in case there is no credit event, no default occurring, nothing is paid by the credit seller, the protection seller to the protection buyer. Right? Now, what are the benefits that are typically there with the credit default swaps? So, we are seeing that we are separating the funding decisions from the credit risk taking decision. These two are separated now, right? The funding is completely different from a credit risk because credit risk taking can be transferred. So the funding part of the decision is completely different from the credit risk taking decision. The rates that are typically the interest rates that go in terms of funding need not take into consideration the credit risk of that particular instrument, because that credit risk can very well be mitigated by going with a credit default swap, right? So that is one advantage the CDS is providing. And if you are looking at from an unfunded perspective, it is very easy to make leverage transactions, right? It's very easy to make leverage transactions, which is resulting in higher leverage. And if the funding costs are much higher for the institutions, it is much beneficial as well. So what amount of leverage do they really want? They can really create through this credit default swap. So that's another benefit that is coming out through the CDS. And by investing in a CDS, I really don't need to get into the process of assessing the worthiness of the loan, servicing the loans, assigning the loans. All these costs are typically being eliminated. So investors have a real advantage going for investing in these credit default swaps, and they can get different maturities depending and even that could be the same as the term of the loan, different from the term of the loan, but in some cases it could really add up a benefit, right? They can get the maturities different from the loan. If I am going with the servicing of the loan, probably I need a maturity of definite of 20 years. Whereas if I am investing in a credit default swap, probably the maturity could be much different from the time period of the loan. So it is completely customizable to the requirements of the investors, and the risk management is becoming more and more flexible. I'm not removing the loans from the balance sheet, but at the same time, the credit risk is getting reduced drastically. Right? In case of securitization, the loan assets are removed from the balance sheet, but here that is not happening. So we are looking at purely a spread view of the credit. The difference in the difference in the basis points is typically being looked at. So that is what we are calling as the spread risk of the credit. Cash and CDS markets, whatever the dislocations that are there, that are giving the kind of opportunities for value investment. So, as I've already highlighted, the funding decisions are separated from credit risk decisions. Similarly, we see that the client relationship is completely separated from the risk decision, right? So, because the reference entity on which the CDS is being typically taken, so A and B might enter into a CDS saying based on the C as a default entity. So if C defaults, B has to compensate A. But here C does not need to know that A and B have got into such kind of a contract. So the client relationship which is existing between the C and their customers, or probably here if you say A has borrowed from C and A is protecting with B. Now the client relationship is here and the risk decision can be something else. So these two are completely segregated in the process. And the liquidity, earlier if it was a loan, it was a highly illiquid kind of an instrument. Now we are bringing in a lot of liquidity to the credit market because the CDSs can be bought and sold in the secondary market quite comfortably. So they bring in a package of all these kinds of benefits. And we also have first to default put. The loans are chosen in such a way that their default correlations are very low. Different kinds of loans are chosen in such a way that their default correlations are very low, because the lower is the probability that more than one loan will be defaulted. If the default correlation is very high, it means that if one of them is defaulting, all others can default equally well. So the lower the default correlation, what you see is if at all one is defaulting, there is no chance that the other will default. But if the default correlation is much higher, what we might observe is if one is defaulting, probably all others can default. So it means that it's like all are defaulting together or none are defaulting together. So that's where the loans are typically chosen in such a way that the default correlations are very less. So which means more than one loan defaulting at the same time, the probability will be much lower until the expiration of the put. So because of this, the bank is able to reduce its credit risk exposure quite drastically. So if one of the loans is defaulting, there is a compensation because the first to default put, it's a put option which will be compensating. So if the bank has chosen the loans in such a way that only one of them is defaulting, and if one defaults, the others don't default. So what typically happens is when the first default has happened, the bank is compensated because it's a put that it has taken. So there is a compensation against that one single default. But of course, the problem is if many defaults occur, then the compensation is only for the first one. So many defaults will occur only when the default correlation between them is much higher. So if the initial Initial assessment is done in such a way that the default correlation between the loans that they have accepted is exceptionally lower, then the bank can get benefited out of this process. So here we could see that this entire thing is a function of number of names that are there in the basket, the number of loans that constitute the basket, the amount of correlation that is driving the different reference entities that are there in the basket. That is the one that is differentiating to what extent this put is effective in reducing the credit risk for the bank. And the spread, which is the amount that needs to be paid by one party to the other, protection buyer to the protection seller, it is in between the spread of the worst individual credit and the sum of the spread of all the credits. If the correlation, so if you are looking at, if the correlation is if the correlation is very low, then the typical loss is the worst individual credit. But if the correlation is very high, then it's the sum of all the credits put together. Right? So that is the kind of a difference that we are typically looking at as the spread in terms of the pricing of the default put. So it will lie anywhere between the spread of the worst individual credit and sum of spreads of all the credits. So if the correlation is very low, it would be the spread of all individual credits, and it would be if the correlation between them is very high, then it's equal to the spread of the worst individual credit. So in generalization, I can have not just the first to default, I can have a second to default, third to default, nth to default kind of puts as well. The protection is given only for that nth defaulting entity. So that's where the workout has to happen in terms of how many are going to default, for what we have to have, what kind of a protection, how much has to be the premium basis points that need to be paid for compensation of what kind of a default. This entire workout has to typically happen. Then we have another tool which is reducing the credit risk in the process, which is the total return swap. So one party is making this because it's a swap, one party is making one payment, the other is compensating the other. You could see here. So here the bank is selling the credit risk. So it's a protection buyer. And this is buying the credit risk. So it's a protection seller kind of stuff. Think of it like this. So the bank is exposed to the credit risk because of the loans that it has issued. So it is planning to transfer the credit risk to the buyer of the credit risk. Now, the total, so in this process, there is no real exchange or selling of the loan. But the swap agreement is like the total loan return, whatever the return that the bank gets on the loans from the various borrowers, that would be paid to this party at regular intervals of time. So that total loan return will include a coupon as well as change in the capital gain or a loss that is coming on that particular loan instrument. In return, there is a pre-specified amount that is being paid by the buyer of the credit risk. So basically it is accepting the risky instrument and it is compensating with a less risky. It's basically like LIBOR plus X basis points. Plus, if at all there is any kind of a depreciation in the price. So capital gain would be paid by the bank to this part, and if the capital gain is negative, obviously bank cannot pay a negative to this buyer, which means the buyer is paying a positive to the bank. So this is how a typical total return swap works. So basically when there is a decrease in the value of a portfolio, you could see only the coupon will be paid by the bank to the buyer, whereas a LIBOR plus X basis points plus whatever is the decrease in the price, the whole compensation would be done by the buyer of the credit risk to the bank. Now this is where the bank is very much mitigating its credit risk in the entire process. Because if the value of the underlying has typically gone down, it is getting a compensation because the buyer of the credit risk is compensating it with the difference in the price fall. So it is mirroring the return on some underlying instrument. So the bank is going to get definitely the LIBOR plus X basis points at regular intervals of time. So this is the kind of a amount that it is coming. So it's a mirroring the retelling of some underlying instrument, a bond or a loan or a portfolio of the bonds. So all the risk, market, credit, everything is being transferred. Why market? Because if there is a change in the value, that change also is being transferred. If there is a default, even the default is transferred. So both the market risk as well as the credit risk are transferred from the seller of the credit risk to the buyer. And generally the maturity of the swap is much shorter. So the loan could be a 20-year loan, but the swap could be only for a 2 years or a 5-year kind of a period. And look at the purchaser of the total return swap, right? Whosoever is receiving the cash flows and the benefits of the underlying loan are being received. And in turn, if there is a rise in the value of the assets, he is receiving the increase in the value of the assets. But if there is a decrease, they have to pay for the fall in the value of the asset. So if you look at it, it's an interesting. It's a synthetic long position in the underlying asset. Look at it from a buyer's perspective. So it's basically like he has purchased the asset. So because he has invested in the loan, he is getting the coupon and the price appreciation or a depreciation for that particular asset. So it's like a synthetic. The buyer has gone for synthetically without really buying, he has really bought the exposure to the underlying asset. And from the bank's perspective, it's a short position. So there is an unlimited upside as well as downside potential. If the value of the asset has gone up drastically, the buyer is getting a much bigger benefit. If the value of the asset falls drastically, the buyer is losing very heavily. And in this case, there is no real exchange of the principal, right? It's not like a cross currency swap where the principal is exchanged and there is no change of ownership. It's only an agreement between the two parties wherein they exchange the cash flows at regular intervals of time. So no change in the voting rights, no corporate related activities here. It's only an agreement between the two parties wherein the cash flows are exchanged. Just like many other swaps, even this swap works on a similar line. So whatever the bank is selling, so the bank that is selling the TRS, total return swap, it is buying the underlying assets. Right? It is hedging against the market and the credit risk, which is buying the underlying asset. The other kind of an instrument that can come in handy to reduce the credit risk is the asset-backed credit-linked loans. So it's nothing but whatever is the medium-term note that is there, whatever is the loan instrument or a bond instrument that is there, this is packaged with a default swap. Right, that is what we are calling as asset-backed credit-linked note. If you look at the example, okay, I'll come back to this. So there is a debt obligation with a coupon, just like this, and the redemption. So here we are talking of the coupon. So there is a debt obligation. This debt obligation is having a coupon as well as the principal, which is the redemption amount. These two are tied to the performance of the loan. So it is not an off-balance sheet transaction, it's on balance sheet, where the principal is exchanged between the parties. And it's a tangible asset. In many cases, it may be leveraged also. In simple form, there is no leverage. I'll tell you what that means. Whereas in many cases, even that could be a leverage by some amount of multiple. And there are no margin calls, which means the downside is very much limited, but there is an upside unlimited, which is more like it is acting like an option. Look at this. From the investor's perspective, let me go back and forth between the picture. Investor wants to invest 105 million in a credit risk. So a bank is having a credit risk of 105 million. Investor wants to invest in that 105 million of that credit risk of the bank. He wants to purchase 105 million of the loan assets of the bank. And there the leverage ratio is being used. Some leverage ratio, let's say 7, which means the investor is only investing 15 million but getting an exposure worth 15 times 7, which is 105 million worth of the assets. Right? So investor is typically purchasing 15 million of the credit linked notes. The bank has issued the credit linked notes, and investor is getting an exposure to 105 million worth by paying 15 million, because there is a kind of leverage ratio of 7 that is existing. So what happens? The bank is transferring. Now let me put it here. Come out here. There is an investor, right? Investor. Now look at here, the bank, right? So the bank, it has given or transferred 105 million worth of the assets here to the trust, and the investor has paid 15 million, leverage of 7. They have invested in the CLNs that are issued by the trust. So for that 105 million, the CLNs have been issued by the trust and backed by the loans of the bank. The investor has invested in that 15 million and taken a leverage of 7 times. So because of that, the trust got 105 million. The loans are transferred from the bank. And if you look at what is that the loans are typically going to give, approximately the loans are going to give LIBOR plus 2.5% extra, 250 basis point. On an average, the loans are carrying an interest rate of LIBOR plus 250 basis point. So the bank has transferred 105 million worth of those kind of loans to the trust, and from the trust has issued the CLN, and the investor has invested in the CLN by investing 15 million, taking a leverage of 7 times. So the trust got that 105 million of the non-investment grade loans, which are going to give this much of yield. So the 15 million, whatever the trust received, right? The investor has invested 15 million. So the trust has got that 15 million against 105 million, which is the exposure. Now this 15 million the trust has got, it has invested in US Treasury notes, which are giving 6.5% frozen, fixed. So that is how the trust has operated. Trust is having a high credit rating. Trust has operated in that 6.5 million. 6.5%. The 15 million which the investor has paid has been used to purchase the treasury notes. Look at the flow. Now, the bank has got 105 million loan. The basic financing of the bank for those loans, where did they get that 105 million? It must have financed it at a LIBOR, right? And typically, let's assume it has borrowed it at LIBOR externally. It got it at LIBOR, but the instrument, the loans that it has given are going to fetch LIBOR plus 250 basis point. So basically 250 basis points is the kind of a benefit the bank is going to get if it has retained the whole stuff. Now, whereas here you could see the trust is giving 150 basis points. right? So LIBOR plus 100 points is for the covering the default risk. So it is receiving LIBOR plus 100 basis points to cover the default risk of the investor. If at all the right, it has typically financed it at LIBOR. So if it has retained the whole thing, it would have got 250 basis points. But in the process, if it is a completely non-investment grade, the spread is 250 basis points. Now it got leveraged. So which means the yield, in case of success, the yield is going to be, now if you look at here, it's 150 basis point that is coming out here because 100 basis points has been used to take a protection to cover the default risk of the investor. So the net out of 250, 150 is going out here. But if you look at the total leverage yield in the entire process, you could see 6.5% is coming because of the treasury notes, and that 150 basis points multiplied by 7. So 17% is the leverage yield that is coming for the trust in the process, right? 150 basis points is coming up here because 100 is being retained by the bank and the remaining is being paid. So 150 basis points are transferred to the trust, and from the investor standpoint there is a 7 leverage. So overall the leverage yield is close to 17%, and there is a premium of 100 basis points to cover the default risk of the investor. So this is how the typical asset-backed credit-linked notes are going to operate. Then moving on to the other instruments like spread options, they are not purely credit derivatives, but they have the credit-like features. So you look at the underlying yield, here is the spread, right? A nominal spread, which is nothing but the yield on the corporate bond minus the treasury bond, same maturity. That's the spread. So and the strike price here is nothing but the maximum of the spread at maturity minus the striking spread, multiplied by the duration, multiplied by the notional amount. Now if you see the wider is the spread, the lower would be the bond prices and vice versa. So this is not a pure derivatives, credit derivatives, but it has features that are linked with the credit. Then we do have the other processes like collateralized debt obligations, wherein we have two major subgroups: collateralized loan obligations (CLOs) and collateralized bond obligations (CBOs). And majority of these securities are collateralized. In case of CLO, they are collateralized by high yield bank loans, and in CBO, they are collateralized by high yield corporate bonds. And typically, they are being used to free up the regulatory capital, right? They are more like your securitized instruments itself, and they can use wide amount of leverage in the intermediation business. The efficient securitization structure really allows the cash flows from a pool of loans or bonds rated at below investment grade to be pulled together. So basically all the subprime loans are pooled and packaged, and within that there will be a priority structure. Okay, this much portion is sure to be received, this much portion has slight amount of risk, and this much portion has very high amount of risk. There is a packaging that is happening. So some portion of it where there is a surety. So initially all of them are below investment grade, subprime loans. But when they got packaged, because of the default correlation that is existing between them, not so perfect default correlation, they got created in such a way that some portion of them carry a very low probability of default, which means they get an investment grade rating, and some of them they get a very poor or high yield rating as such. So we can typically see they are repackaged. So initially it's like this. Initially it's like all are low quality loans. All have high probability of default. And I have packaged all of them. I have pooled and packaged all of them. Now within this pool, some portion of the loans have high credibility, some portion have moderate credibility, and some portion have low credibility. So I get this much portion of the loan assessed separately may get a AAA rating. This portion which has moderate credibility will get, let's say, a B rating, and here it gets it may not be rated, or it may be getting a very poor kind of a rating, right? Now within this one can get a low returns, a moderate return, and a very high return based on the risk profile. So which means even the investors also could be very. Initially, if all these are having the similar kind of credit rating, some investment might not have come out. In a regular securitization process, I may not find investors for these kind of instruments. But now that I have pooled them, right, this is what I am calling as collateralized debt obligations or loan obligations or bond obligation. Now, because of this packaging and tranching, I could cater, okay, these investments can be catered to low risk taking investors, moderate risk taking investors, and high risk taking investors, right? So we are getting a different investment rating for each of them. Different investors can come in, because sometimes insurance companies, pension funds, they would not be able to invest in high risk kind of securities. So they may want to invest only in a low or moderate risk kind of security. But if all the underlying loan pool is high risky pool, they would not have got an exposure to invest in that pool at all. But now that these are repackaged and pooled, they get an opportunity to invest in these kind of instruments quite effectively. So the CLOs and the CDOs typically are more or less similar in all the aspects, but the recovery values are different, right? Because if the bonds are very unsecured, they have very low recovery value. But if they are very secured with collaterals, the recovery value could be much higher. And even in case of loans also, the recoveries could be much better. Underlying asset, the average life. For loans, probably the underlying could be much lesser, because they have an amortization structure along with the interest. There is some level of a principal repayment that is happening at regular intervals. So average life of a loan is much lesser compared to that of a bond. So except for these small changes, the entire process remains one and the same. So that's the reason we have to segregate CLOs from CDOs, but otherwise the process remains one and the same. In all these things, there is a special purpose vehicle that is created. Generally, three classes of securities are issued. So this is like highly secured, moderately secured, low secured. So this is called as a senior secured notes. Then we have senior secured class B, and subordinated are probably equity. So typically we call them as senior, mezzanine, and subordinated or equity kind of stuff. So these proceeds, whatever different investors invest in each of them, the proceeds are used to typically purchase all these loans, collaterals, and the bonds in the form of collaterals from the banks. And the weighted average life of the collateral, now whatever they have purchased, the loans, so there could be some loans with 5 years maturity, some loans with 10 years, some loans with 20 years maturity. So the weighted average of these loans life could be much different from the weighted average of the collateral. And there could be gaps in the maturities between the loans and the CLO structure, because they might have issued this as a 5-year loan, this might be issued as a 3-year bond, this might be issued as 10-year bond. So whatever the CDOs that are being issued might be completely different from the weighted average maturities of the underlying loans and bonds. And there is a reinvestment period. The cash flow that is coming from the amortization process, that entire thing has to be reinvested. And even if there are prepaid loans, defaulting loans, all those things have to be taken care of. And even when we are looking at the payments here, so whatever the payments that are coming from here, the structure is done in such a way the first payments typically go to this senior notes. Whatever is remaining out of the principal and interest that needs to be paid, then it goes to the mezzanine tranche, and then whatever is finally left goes to the last tranche. So that way, majority of the risk is absorbed by this equity tranche. After this tranche has completely absorbed all the losses, then the losses start moving over to the mezzanine tranche, whereas the senior tranche is protected to a large extent from any kind of default. So that's a kind of a physical CDO process. So what has happened in that physical CDO, if I have to summarize it, the loans, right? Let me take a simple example, right? There is a 1 million loan, a 3 million loan. This is a 1 million loan with 5 years maturity, a 3 million loan with 10 years maturity, and let's say a 0.5 million loan with 20 years maturity. Let's say these are all very risky kind of loans. So what the bank does, they sell all of them to a third party. Now the third party has got a loan pool of 4.5 million. Now let's say if they are individual, so probably here I may say that I may recover, let's say 80%. So 800,000 or 0.8 million can be recovered. Here also let's say 2.5 million can be recovered, and here probably 0.4 million can be recovered. So the remaining is for the collateral that has been given or for whatever reason. So it's like 3.7 million can very well be recovered. So what I can say, I'll create an instrument saying 3.6 million approximately is a senior tranche. So I'll issue senior rated bonds worth 3.6 million. Then let's say around for 0.4 million or 0.5 million, I would be issuing the mezzanine tranche, and the remaining 0.4 million I would be going with an equity tranche. So this would get a very high credit rating, this would get a moderate credit rating, this would get a lower credit rating. So whatever the payments that come from here, those and the weighted averages could be different. This I may issue it as 5 years, this I may issue for 7 years, this I may issue for 10 years. But whatever the payments that are coming from here, they are used to make the payments for this investors first, because they are less risky. Then whatever excess that has been collected, it goes to this, then it goes to this. So which means there is a physical transfer of the assets from this party to this party. That is a traditional CDO. Whereas, so the main difference between CDO and the securitization is, in a regular securitization, you see that this kind of tranching does not happen. Right? In a traditional synthetic CDO, in a traditional CDO, collateralized debt obligation, we see this kind of tranching, repackaging, pooling of the loans, and then creating different instruments of different maturities and then issuing it to the different classes of investors. On the other side, we also have what is called as synthetic. How do I differentiate? For that, I need to understand what is a traditional CDO, which I have just highlighted. So the credit assets are fully cash funded. debt and equity proceeds are there. So the capital is raised by the SPV and the repayment is completely tied up to the cash flows that are received in the form of principal and interest from the borrowers. Whereas in a synthetic CDO, we are not bringing in any kind of legal transfer of the ownership. The assets, the loans are not sold physically to a third party, but instead that process is accomplished through credit default swaps. So only the credit risk which is being faced by the bank is being transferred to the SPV. It's not the credit risk assets that are transferred. Only the credit risk is transferred to the SPV, wherein the bank will purchase a credit default swap by transferring the credit risk from the bank to the SPV. So the assets are typically present on the balance sheet of the bank itself. And for some portion of it, there could be a transfer, and for some portion, it could be in the form of a super senior swap. So when we look at the diagram, it becomes more easier. Look at this diagram, which you can understand it much easily. Look at now. This is the originating bank. It has issued the loan. Let's say it has issued the loans for 500 million. Out of this 500 million, the 450 million, let's assume that it is more and more secure. Right? There is a 10% probabilities of default. So out of this 500 million loans that the bank has given, let's assume 450 million is more or less secure, 50 million is more risky. Now what the bank does, the 450 million, it transfers, it gets into a kind of a swap agreement with a highly rated counterparty, saying these guys would be paying the premium at regular intervals, and if at all the default happens on that 450 million, this is a super senior, means first that 50 million loss should happen. After that 50 million loss, if there is any extra loss that is happening, that is where the compensation comes from the highly rated counterparty. That is where we are calling it as a super senior swap. It's not coming every time. Only when the losses cross the 50 million, the compensation is coming in. So for the 450 million, this is the agreement that comes up. For the first 50 million, the bank is typically going for a credit default swap. So what is happening? The bank is getting into a credit default swap with a SPV. SPV is the protection seller, the bank is the protection buyer. Right? Now, and for that 50 million, the government securities are being used as a collateral. And how are the government securities being used? The SPV typically is paying that 50 million into the market, whatever the 50 million that it has received from the bank, using that 50 million to purchase the different government securities from the market, and that government securities are being used as a collateral. Now, this SPV, in turn, the 50 million is typically passing them on in the form of credit linked notes for that 50 million to the investors. So it has repackaged that 50 million, portion of it into a senior notes, into mezzanine and junior equity, all these kind of tranches. So these guys are bringing in the cash. This cash is being used to purchase the securities from the market, and these securities are typically used as the collateral, and based on that collateral, the 50 million credit risk transfer is happening here. That 50 million again is being transferred to, so there is a two-step credit risk transfer that is happening. For the 50 million, the bank is doing a credit risk transfer to the SPV. SPV in turn is transferring it to the investors. And here the 50 is not physically transferred, the 50 is transferred in the form of a credit default swap. right? So because the bank is still having the 500 million, 450 it has done a super senior swap premium. That's the protection that it has taken. For the 50 million, it has gone for a credit default swap. And to protect itself against that credit default swap, it has issued the credit linked notes worth 50 million. So there is no real transfer of assets from the bank to the SPV to the investors. It's only the credit risk that is transferred in this synthetic CDO. And in some cases, a small extension of the same where we can have a single tranche CDO. In case of synthetic CDO, we have seen a mezzanine tranche, we have seen a senior tranche, subordinated tranche, all these things. Whereas in case of a single tranche, the only difference that you find is in a traditional CDO, the entire portfolio may be ramped up. The entire capital structure is distributed to multiple investors. We have a senior tranche, we have a mezzanine tranche, all that. But here, only one single tranche, probably a mezzanine tranche, might be is simply created. Not all tranches are created. Only a mezzanine tranche, which means only a moderate risk-taking investors are being looked at. So we don't build the whole portfolio here, because the bank is actually getting into the hedging process where the underlying reference assets are being purchased or sold according to the pricing model that it has developed internally. So it can happen that the credit protection like CDS can be got only for a mezzanine tranche, and it can still retain the equity tranche, whatever is the loss that is associated with the equity tranche or the super senior kind of a tranche. So it is allowing the client to tailor the most of the terms of the transaction, but of course the liquidity is very well a concern. And the bank has to dynamically hedge the tranche because the liquidity is a very constant problem here. And whatever the assets that they have purchased or sold, based on the quality and the correlation of the portfolio changes, the required action has to be taken accordingly. Now this is what happens. You have your entire reference portfolio. Senior, you are keeping it with you. First class, which is the equity tranche, you are keeping it with you. Only the mezzanine tranche, you are taking a credit protection by going with a CDS. Right? Only this particular tranche, you are going for a credit protection. So you are paying some kind of a premium, receiving in case there is a default on this particular tranche. So that's how a single tranche CDO differs from a traditional CDO. So these are all the different kinds of mechanisms that are there where you can transfer the credit risk that is present in the various instruments to you can transfer it to the market. You can reduce the credit risk involved in the overall process. So almost all these things we have spent a good amount of time and tried to get a good hold on each of these aspects. If you have any further queries regarding any of these, please get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.